The U.S. economy is collapsing. Dick Fuld is the CEO of Lehman Brothers. He is sitting in his office and is quite worried about the collapse of the U.S. economy. His own company has lost millions of dollars in the last few minutes. Fuld calls Henry Paulson, who is the Secretary of the Treasury, to talk about the ongoing situation. Paulson also shows concern about the problem of Lehman Brothers, but Fuld tells him they need to make people believe that Lehman has enough money to survive. Fuld also mentions that he plans to call Warren Buffett, who is the richest man in the world, but then he asks Paulson to do it since he knows Buffett better. Paulson begins to think about the damage that Lehman's bankruptcy could have on the world economy and the future of the United States. He meets with his advisor, Jim Wilkinson, and press officer Michelle Davis, and explains his fear that if Lehman collapses, it could cause panic and hurt millions of people. In a last-ditch effort, Paulson calls Buffett to discuss the situation of Lehman Brothers. But Buffett doesn't seem much interested and says he'll think about it. Meanwhile, Fuld's attempt to make a deal with Buffett falls through because he finds Buffett's offer insulting and rejects it. Still, Fuld remains confident, believing that the real estate market will improve and Lehman will come out strong. After Fuld decides to reject the much-needed offer, Paulson quickly meets with Ben Bernanke, the chairman of the Federal Reserve. They discuss what could happen if Lehman failed and how they needed to act fast to stop other banks from bankruptcy. During their discussion, Paulson realized he would have to make a tough decision because letting Lehman fail could cause millions of Americans to lose their money and homes. But bailing them out might send the wrong message that the government will rescue anyone who fails. The situation gets more serious when Fuld meets with his investors to talk about the situation. They urge him to stabilize the stock price. They also threatened him that if he didn't, his Wall Street brokers and clients would pull out.
Both Aaron Callan and Joseph Gregory are out at Lehman Brothers.
In a desperate move, Fuld fires his COO and hires Bart McDade, hoping he can find a buyer to save the company. Their top option is a group from Korea, and they set up a meeting with them. Fuld isn't part of the meeting, but he keeps calling Bart to ask how things are going. Bart tells him that the buyer doesn't seem convinced, but he's doing everything he can to close the deal. As time went on and the negotiations stalled, Fuld unexpectedly stepped in to negotiate with the Koreans himself. This offends the buyers, and they walk out of the meeting. In the middle of all this drama, Fuld calls one of Paulson's advisors and begs him for help. The advisor tells him he should do what's best for the company, even if it means selling it for pennies. Fuld is angry at this suggestion and says that Lehman Brothers is a powerful company, and he's not going to give it away. After this, Timothy Geithner, president of the New York Fed, talks to Henry Paulson about the collapse of mortgage giants Freddie Mac and Fannie Mae. He says the only solution might be government intervention. Paulson disagrees but tells him he's working on a plan to fix the problem with as little damage as possible. Henry then traveled to Beijing for the Olympics, and during the trip, he met with the president of China. The president tells Paulson that the problems in the U.S. are already affecting China and Russia since both countries own shares in Freddie and Fannie. If those companies go bankrupt, they will lose a lot of money. He also tells Paulson that Russia offered to destabilize the U.S. economy by dumping thousands of Freddie and Fannie bonds on the market. But he turned down the offer politely, making it clear that this option is still on the table if Paulson doesn't solve the problem. Paulson is very disturbed by this threat. He then meets with Ben Bernanke and tells him that the conversation in Beijing was a reminder that with one phone call to Moscow, these two powers could bring down the U.S. economy. So now selling Lehman becomes even more urgent. But it's clear that no one wants to take the risk. At this point, Barclays, the British Bank, and Bank of America are the only potential buyers. But neither of them is willing to make the deal without government guarantees. And Paulson himself is also not willing to offer them this guarantee. By September 11th, the tension had grown enormous, and the government finally decided to bail out Freddie and Fannie using taxpayer money. Meanwhile, Bank of America executives meet with Chris Flowers, a bank takeover expert, to talk about possibly buying Lehman Brothers at a shockingly low price. During the meeting, they received a call from the president of the AIG, the insurance company that backs mortgage payments in case of default. He tells them that AIG is running out of money. Although this surprises him, Flowers still calmly replies that he'll review the documents later. Now, they're not just dealing with one or two crises. They've got three huge financial problems that they need to sort out as quickly as possible. The pressure on Paulson and his team was immense. Every passing minute seemed to introduce new challenges. As the meeting goes on, everyone watches the news on TV, where it's announced that the government won't be giving money to bail out Lehman or other banks. They're saying the banks need to figure out how to solve this mess on their own without government help. What's even more shocking is that this news comes from someone close to the Secretary of the Treasury. After this, Timothy confronts Paulson, asking who leaked the information to the press. Paulson, without hesitation, admits that he did it himself. He explained that they needed to send a clear message to the other banks about how serious the situation was. Meanwhile, Bank of America executives are growing more cautious about the deal. The deeper they dig into Lehman, the more they see it as a bank full of worthless assets, something that could pull them into a major crisis if they decide to buy it. Paulson quickly meets with Bernanke and announces that he's going to lock all the Wall Street bank presidents in a room at the Fed over the weekend so they can come up with a solution for the Lehman crisis. At the airport before the meeting, Paulson repeats that he won't bail out Lehman. He says Wall Street is addicted to taking risks, and if the government keeps covering their losses, they'll never learn. And now in one room sit the most powerful bankers in the country, including leaders from JP Morgan Chase, Goldman Sachs, Morgan Stanley, Merrill Lynch, and Citigroup. Paulson speaks firmly and tells them they must find a solution to stop the market panic. He warns that if they don't stabilize the situation, the global economy will collapse, and millions of people could lose their homes. He also informs them that by Monday, Lehman won't be able to meet its obligations. And while there are two interested buyers, neither is willing to proceed without additional funding. The bankers aren't very happy, but they split into teams to figure out how to stop the damage, knowing that if Lehman goes down, they could be next. Paulson makes it clear that the government will remember those who don't cooperate. Then John Thane, the president of Merrill Lynch, makes a surprising move. He knows that if Lehman collapses, then Merrill would be next. So he secures a deal with Bank of America and destroys any chance of saving Lehman through that buyer. When Paulson finds out, he tells Thane to do what's best for his company and reminds him that the British are still interested in buying Lehman. Paulson begins to panic. The deal with the British has to go through. Dick Fuld is furious when he learns that the government has allowed the sale to fall apart. Meanwhile, the bankers are still meeting without reaching a deal. So Jamie Dimon, chairman of JP Morgan Chase, speaks up. He says they need to get the message. Everyday people want the wealthy on Wall Street to take the hit because they think they're all overpaid idiots. No politician will sign off on a bailout during an election year. So he suggests that everyone at the table put in $1 billion to cover Lehman's assets that can't be sold. The bankers agree, and Paulson's office gets the good news. Dick Fuld is informed of the decision, and he prepares to speak to the board. But that night, Barclays' regulatory agent in London, Sir Callum, contacts Timothy and gives them bad news. After the call, Timothy tells Paulson that Barclays doesn't have regulatory approval to buy Lehman, and the British shareholders need 30 days to approve the deal. Paulson tries calling the British Chancellor of the Exchequer, but the Chancellor tells him there's no deal. After hanging up, Paulson announces that the British don't want to import the cancer that is Lehman. It's now early Monday morning of September 15, and Dick Fuld still believes the government might step in to bail out Lehman. He hasn't declared bankruptcy yet, even though he needs to do it before the financial markets open. Lehman's regulatory agent is stalling and hasn't yet called Lehman to declare bankruptcy, which angers Paulson. He storms out of his office, telling him to do his job. Dick Fuld meets with the board and puts the regulator's call on speakerphone, expecting the government to step in and save them. But that doesn't happen. Instead, Dick and the board vote yes to file for bankruptcy. The decision to not bail out Lehman Brothers shocks and angers many on Wall Street and in the government. Despite the backlash, Paulson stands by his decision, though it's clear the responsibility of letting the country's fourth largest bank fail weighs heavily on him. Although everything seems fine at first, But the decision to not intervene causes global financial markets to panic. At the Treasury Department, Paulson and his team watch in concern as the panic spreads worldwide, with banks in Europe and Asia starting to struggle. AIG, which had insured huge amounts of debt, including Lehman Brothers, is now on the brink of collapse due to a lack of money. 6 days after Lehman's bankruptcy, AIG faces an even bigger crisis. Paulson again finds himself in another tough spot, having to decide whether to save this key institution to prevent the entire financial system from collapsing, which could cause thousands of people to lose their homes. The whole system is in chaos, and millions of Americans go on with their lives, unaware of how serious things are at the Treasury. Meanwhile, the bankruptcy of Lehman Brothers led to the loss of around 35,000 jobs. Other financial institutions were still in crisis, desperately seeking investors to help them survive. Morgan Stanley struck a deal with Mitsubishi to save 20,000 jobs. Just 7 days after Lehman's collapse, on September 22nd, Goldman Sachs secured a $5 billion investment from Warren Buffett, which helped them avoid bankruptcy. Now, Paulson and his team are working even harder to create a massive rescue plan. The urgency is clear. Time is running out. In the middle of all this, they draft a plan that's only 3 pages long, which will become the Troubled Asset Relief Program. This program aims to stop more banks from failing and prevent the collapse of the financial system so Americans don't end up losing their money or their homes. As they explain their plan, Bernanke warns that if they don't act, the consequences could be worse than the Great Depression. The congressional committee seems ready to agree when U.S. Senator and presidential candidate John McCain announces that he's suspending his campaign and heading back to Washington to work on the legislation. This stops the progress that had been made, as some politicians in Washington started blocking the bill. Paulson soon realizes that TARP is too slow, and even if it passes, it won't save the economy in time. So they decide that direct capital injections into the banks are their only option to get credit flowing again. Paulson gathers the bank presidents again, and along with Sheila Bair, the president of the Federal Deposit Insurance Corporation, informs them that they will all receive mandatory capital injections to help the American people and stabilize the financial system. In this way, the U.S. Treasury decided to inject $125 billion into 9 of the biggest banks, even though some of them didn't actually need the money. The goal was to stabilize the financial markets. Bank of America received $15 billion. Bank Mellon Corp got $3 billion. Citigroup got $25 billion. Goldman Sachs got $10 billion. JP Morgan Chase got $25 billion. Merrill Lynch got $10 billion. Morgan Stanley got $10 billion. State Street got $2 billion, while Wells Fargo got $25 billion. This was all part of the effort to help both the banks and the economy recover. The idea behind all this effort was that by getting credit flowing, small businesses like restaurants and stores could borrow money. This would help them to stay open and keep the economy going. In the end, Henry Paulson wonders if the plan will succeed, because he was not sure if the banks will actually lend the money they were given. His face shows the emotional weight of having been at the center of a crisis. He was under a huge burden of saving a system that was on the brink of collapse. However, after TARP was put into action, the banks didn't lend as much as expected. This caused the market to keep falling. On the other hand, unemployment kept rising, and millions of families lost their homes. Finally, in 2009, the market stabilized, marking the end of the crisis.